Good morning. Thank you for joining us today for our Farm Foundation Forum on Investing in Agriculture. We are excited to have you here to engage with our expert panelists today as we take a landscape view of investing in food and agriculture. My name is Sherry Rogie-Fiddler, and I'm the President and CEO of Farm Foundation, located just outside of Chicago, Illinois. I'm also a fifth-generation farm owner from Nebraska and began my career in financial services in London, then had the pleasure of working and investing in various parts of the food value chain. So I'm delighted to host our discussion today on this important topic as we look ahead to the future of investing in food and agriculture, from farmland to food and technology. Before we begin our forum, I'd like to quickly go over a few housekeeping rules. And before I even dive into these, I will just say we've already had a few Zoom glitches this morning. So please bear with us if that happens again. The link, just click on the link again and we should be back in a minute or two if that should happen again. But if you just look across these housekeeping notes here, you can submit your questions throughout the whole event, and we encourage you to do so, so that when the time comes for Q&A, we'll have those already loaded in. But when you're submitting the questions, please make sure you include your name and the organization, so that we can take the context and understand the context of your organization. Due to the time limits, we will undoubtedly not get to all the questions submitted, but really thank you for submitting them in advance. Also note that the forum will be recorded and we'll post it on our website after the event, and you will also receive a very brief survey at the conclusion of the event, and we encourage you to take a minute to complete that for us as well. Established in 1933, Farm Foundation actually is one of the first institutes focused on agriculture in the US. And Farm Foundation is now positioned as an accelerator of practical solutions for agriculture, accelerating both people and ideas. Our vision is to build a future for farmers, our communities, and our world. And our mission is to build trust and understanding at the intersections of agriculture and society. We accomplish this through objective discussions, just like we'll be having today, as well as a host of other new initiatives and programs. So I invite you to reach out to learn more about our bold plans for the coming years and how we might collaborate together. If you are posting on social media this morning, please use hashtag FarmFoundationForum, noted here. You can also connect with us on several different social media platforms, and we encourage you to do that too. So we have lined up 4 wonderful speakers today for a landscape investment view across the food supply chain with a focus on technology innovation, as well as private equity model for farmland investment. We will begin with 2 of our broadest investment theses across the food and ag sector, and then we'll move on to a little more focused lens after that. Our panelists include Shauna, Christina Rohr, Kirsten Stead, and Joelle Faulkner. We're going to start by hearing from Shauna, partner at Better Food Ventures. Shauna brings over 12 years of investment, M&A advisory, and technology experience to Better Food Ventures. Thank you again for kicking off the forum, Shauna. So over to you.
Thanks, Sherry. It's great to be with everybody. So just quickly in terms of level setting, the introduction here and what we're going to cover today in a very short time period. Next slide, please. Why I'm calling this the investment arc, as I was thinking about what to talk about today in this topic, and really what does the future hold, the idea of a curve and level setting kept coming to mind. So I thought it would be instructive to look at where we've been, where we're going, and sort of what we've learned. Next slide, please. I'm one of 4 partners, Shauna Day. I've got a background in technology investment banking and spent about 15 years in that sector, looking at all kinds of different technologies from enterprise software, communications infrastructure. And about 6 years ago, I decided I was ready to return to my roots in the central part of California. So I moved back to the Central Valley from London, which was a very unusual move, but nevertheless fantastic. So I've spent the last 6 years kind of in the middle of California's ag land, really digging in deep and focusing my efforts on ag technology. I've got 3 other partners, Britta Rosenheim, who covers food tech, Michael Rose, who's our indoor ag specialist, and our founder, Rob Trice, who's our jack of all trades and really covers all sectors for us. Fundamentally, we are early stage investors in ag tech and food tech startups. We also do some advisory work with larger corporates who are looking at the IT innovation ecosystem, and typically those are big food and ag companies. Next slide, please. So some of you might recognize the farm tech or ag tech landscapes. I publish one of these a year. I've also done a livestock tech landscape, and presently my partner Britta and I are working on food supply chain technology. So really, I want to kind of level set here in terms of the lens that I have on the marketplace and what we do as a firm. And it's really IT for food and ag, or digital tools for food and ag, and that's hardware, software applications. So within this landscape, you can really kind of see those tools and technologies that are focused within the farm gate. And as I said, our next landscape, which I hope we'll have out in the next couple of weeks or month, will be focused from farm gate through to distribution. Next slide, please. Thought it would be interesting to also include for the audience the food tech landscape that my partner Britta focuses on. And this is really looking at connected kitchen applications, personalized nutrition, grocery, e-commerce on the left-hand side in home, and then out of home, looking at restaurant technology, food rescue, workforce management. And you can see that this is even more of an eye chart than the farm tech landscape. And this is only North American as well. So mine on the ag tech side is really more global. Britta's is because of space constraints, really North American. So you can see how much activity there has been in that food tech part of the landscape. So let's just do a quick retrospective here. And there's a kind of adoption curve on the next slide. Next slide, please. Thank you. That I think is really instructive to think about technology adoption. And you can really apply this to almost all aspects of technology, whether it be communications, enterprise software, SMB software, or ag tech. And what you basically have here is a sort of is a curve that looks at a technology trigger. So what are those early stage sort of potentially disruptive technologies that are emerging in the marketplace? How do those sort of track to a peak of inflated expectations where the media has gotten excited about it? You see a lot of venture activity. There's a lot of focus on these particular technologies. They are then typically followed by a trough of disillusionment, where you really find, business models perhaps are not well thought out or sort of gain traction in the market. You start to lose some momentum in terms of investment, in terms of the darlings of the media. And really, that trough of disillusionment is important, because that's where those companies that have the right leadership, the right product market fit, and are able to perhaps do more with less capital to really reinforce their business models, those are the survivors. And coming out of that, you get the slope of enlightenment. You start to get some early yet meaningful market traction, and you start to become a more mature technology, sort of emerging from that slope. So next slide, please. So this is a great overlay of precision ag that was done in 2016 by Kiersten and one of her partners, Ryan Rakestraw, at Monsanto Growth Ventures at the time. And I think this is just a really, really interesting way to look at the precision ag adoption curve. And as you can see, we've highlighted some in red, that are some that we've heard about in the media. And again, if we can all think back 4 or 5 years ago, something like blockchain was still very, very early. Drones were at their peak of expectations. A lot of capital had flowed into those business models. Now, if you fast forward to the next slide, I've sort of looked at this from a 2020 perspective and sort of tracked some of those movements among those red technologies, as well as some others that we've seen come into the market. Carbon marketplaces, bee technology, pollination technology. We're seeing a lot of interest and activity in that space now. You will see that blockchain we have in the trough of disillusionment. And it's not to say that there's not great potential here, but there are a tremendous amount of companies and startups who are talking about this, and there's been a lot of noise. We're still sort of waiting to see the meaningful business models emerge from the blockchain infrastructure. But I think myself and many others believe it will happen. We've just sort of gone through the hype cycle with the technology like that. Even with drones, now we're starting to see that come out of that trough of disillusionment with some new business models, some new applications that have more scalability potential, particularly in our market. Next slide, please. So I wanted to kind of overlay this again with the technology adoption curve and just sort of in a retrospective, when I really started to focus on this market in 2014, 2015, there were a lot of people talking about fragmentation, talking about lack of operating systems, talking about lack of connectivity, but the pieces had not even been laid on the table yet. Sort of fast forward to where we are today, I think there's a good understanding of the importance of standards, of traceability, interoperability, data platforms. Those pieces are coming into play. You're starting to get more and more trust built between counterparties, between stakeholders in the ecosystem with startup technologies, and really, thinking about where we're going, and again, overlaying that with the adoption curve. In the next 5 years or so, I think these pieces are really going to come together, and that right product, right products customer need, I think, are really going to start fitting together, and people will begin to see the real value from the technologies that have taken some time to sort of get organized, the data sets, becoming more aligned, more interoperable, and really that sort of that unlocks the opportunities for more mass market adoption. Next slide, please. So just kind of summarizing on where we are today, a lot of people sort of ask us, we hear what we hear in the media versus what we see on the ground can be disconnected sometimes. And I always want to sort of level set with this staircase of, we've got to crawl before we walk, before we run. And in many ways, we're still very much in this first and second step of the adoption staircase here. People are just sort of moving from pen and paper, what they've always instinctually done, to starting to capture that information digitally. Now we have a couple of years of that data. We can kind of measure, why did not only do we know what happened, but now why did it happen? We're starting to see more maturity in data management systems. And really all of those things that we're from an investment standpoint, from an adoption standpoint, we're excited about the future of automation and optimization. But again, we have to level set in this kind of stair-step approach of foundational record keeping, foundational digitalization before some of those more advanced technological innovations are really possible and used at scale. Next slide, please. Okay, so that's a little retrospective of where we've been. So let's kind of transition now to a little bit about what this all means in the investment landscape. So I kind of crunched my own numbers here and looked at investing from 2016, which again is really when AgFunder, who does a great job of tracking investment activity and deal activity in the space, really started to publish annual reports and sort of reveal where a lot of the technology adoption and investment was going. And I subdivided this into farm technology, ag biosciences, genetics, what we call the messy middle, but that's really from the farm gate through distribution, restaurant, food service, et cetera, and then the consumer experience. And what's not reflected here are alternative proteins, indoor agriculture. This is really more sort of digital technologies in food and ag. And I think, so the solid line is the actuals. I've sort of taken a crack at forecasting based on the trends that I'm seeing in the market now with the dotted lines and kind of where we are post-COVID. I think the potential to have some sort of more meaningful accelerators here are really on the right-hand side, those comments on the right-hand side. There are some interesting programs now being led by USDA, by NRCS to look at soil health. And if some of those initiatives start to really take off, I could see more investment flowing into those programs. One area that I think has a tremendous amount of potential that has to date not been heavily invested or sort of agreed upon is really digital standards for regulatory reporting. And we know that this is a huge pain point for most growers and ranchers. who continuously are sort of overwhelmed with the amount of paperwork and reporting that's required. So to the extent, we start to see some movement on sort of regulatory matters in that way, I think that could unlock a lot of innovation and efficiency for producers to drive adoption. So this is just, again, a look at where we've come from in terms of investing and where I think we're going over the next year or so. Next slide, please. So this is one that I always think is interesting, and as the title says, is venture capital aligned with market needs. So on the last slide, you really saw significantly more investment has gone into the consumer experience, right? Meal delivery kits, last mile delivery, restaurant discovery, and of course, these are all very important technologies as the consumer sort of demands more and more tools and digitalization and access to information. On the other side, we have kind of a barbell approach here. So on the other side, we see a fairly sizable amount of investment in the first half of the year that's gone into farm tech and ag bio, 3 billion on that side, 4.1 billion in the consumer experience. Yet only about 15%, and this trend holds, this is actually slightly higher than previous years, has gone into deal flow in the messy middle. So early stage, or not even early stage, but innovation investments in that messy middle from the farm gate through distribution. And I think, as we look back at COVID and what we've learned during this process of, really a unprecedented dislocation in our food system, we start to say, okay, when and how will we start to transition more investment capital, more innovation into that messy middle to create a more agile and responsive, food system in a lot of the places that we saw really break down. And whether we're talking about food safety, whether we're talking about labor, employee safety, distribution, logistics, these are all areas that we see significant potential for investment, over the next couple of years. Next slide, please. And so finally, I wanted to also share a couple of just investable themes that we see, going into 2021, and really beyond the farm gate, I would say. I just wrote an article a couple of weeks ago about institutional ag land investment and the kind of trigger that we've seen in those, pension funds, large food and ag investors. We're really driving technology adoption on the farm, whether it be operational excellence, better reporting, ability to sort of manage risk or enhance returns through technology. We really see a strong potential there, and that's already taking place. On the farmland lending side, I think we've also seen the adoption of new technologies, whether they be to automate farm financial information, data entry. We've also seen the application of technologies in looking at risk and portfolio management. There's some water quality and water availability companies on the West Coast that I know lending institutions are using to evaluate the risk of their portfolios. So I think there's some really interesting triggers there and opportunities for adoption, outside of the farm gate with some of these financial stakeholders. Also on the handling and processing side, Industry 4.0, I think that's going to have some significant opportunities for investment in processors and handlers, looking at industrialized systems, looking at, again, food safety, labor efficiencies. And then of course on the CPG and brand side, we're seeing much more demand, much higher demand, a lot of pressure on the supply chain to deliver on sustainability and traceability commitments that they've made. And really those technology systems, the ability to communicate that information from within the farm gate through the supply chain is critical to be able to deliver on those promises. To date, we've seen relatively little actual adoption there, but I think the potential is significant. And this is just a case of we really need to get focused on standardization and how that information flows through the various stakeholders in the supply chain. So just a quick wrap up here, what we've kind of learned over the last 5 or 6 years. look, the importance of trust, I think that goes without saying, but it's not just trust at a big sort of macro level. It's who do you trust to house your data? Who do you trust to get advice from, prescriptions from? And I think technology companies are really starting to understand the importance of that trust and how long it takes to earn it and how quickly it's lost as well. The other thing that I would say is and data isn't worth much without insights. This often breaks along generational sort of generational transfer here. I think there's a lot of fixation on data and data security, rightly so, as there should be. But really, sort of what insights are we able to get from that data? I think that's the important question to ask when we start thinking about how we treat our data. User experience, user interface, again, goes without saying. You've got to make products that are easy for people to use, that are intuitive, that anybody in the operations, if it's a farm technology application, anybody can use without a lot of training or without a lot of disruption to their workflows. The next point I think is an important one. I think we've really started to see, especially in the investment side, the importance of systems and understanding how these technologies fit into a broader system versus standalone point solutions. I think this concept of systems is important, and it really goes back to interoperability. In 1995, did your Excel application work on your Mac? Probably not, or it was difficult. The interfaces were challenging, so we really need to do more work on that front, but I think that's coming. And finally, sort of post-COVID, what do we expect? From an investment standpoint, certainly sharper focus on need to have versus nice to haves, particularly in an environment in commodity crops, for example, row crops, for example, where wallet shares are really sort of tightening as commodity prices are under pressure. We really need to focus on, are these a nice to have or a need to have? We've certainly seen remote worker dependence on cloud and mobility. Whether it be on the sales side, retail sales, advisors, learning tools, using YouTube. So I think that's been a real catalyst and will continue to drive transition to cloud and mobility solutions. And then of course, people get information from different sources. So omnichannel experiences, are you using your mobile device to search for information about a particular product? Then do you go into the store and buy it? There are a lot of touch points now that farmers and ranchers are using to get information and to make purchases. And so we see that continuing into a post-COVID environment as well. So I know I moved through that pretty quickly. I always like to end on this. What is all of this worth? All of these technology tools, these productivity tools. The idea is that it should allow farmers and ranchers, it should allow producers, food processors, to have more time to work on the business and in the business. And at the end of the day, technology is a tool in the toolkit. It's not going to solve all of our problems, but it will hopefully create more opportunities to work on the business rather than in the business. Thank you very much.
Great, thank you so much, Shauna. And just a quick shout out, Shauna actually had an article in Forbes in the last week or two. So Google that and you can follow up and see her insights shared on Forbes as well. So just a reminder too that you can submit your questions throughout the presentation, and a reminder to please put them in the Q&A section, not the chat section, because that lets us sort the questions as we go through our time together. So next up we have Christina Rohr. Christina is a principal of investments at S2G Ventures, and Christina's portfolio work ranges from agricultural focused investments in genetics, crop protection, soil health, and digital technologies, all the way to consumer-facing brands. So Christina, thank you for joining us, and over to you.
Thank you, Sherry. Great to be here. So a little bit of background on S2G Ventures. If you can move to the next slide, please. So we are a venture capital fund focused exclusively on food and ag. We invest in entrepreneurs and innovators that are trying to move the food system towards sustainability and/or health, and preferably both. We invest holistically, soil to shelf. So we have invested in ag tech, food tech, supply chain, brands, and retail concepts. So the entire value chain is addressable. We believe this gives us insights into system interdependencies and signals hopefully early on before they become trends. We are multi-stage. We invest in seed companies, venture, and growth. We currently have about 50 companies in our portfolio, and we have co-invested with more than 250 syndicate partners, which includes strategics, foundations, and universities. We are big believers in collaboration to catalyze change across the food system. We focus in United States, but we're also expanding our reach beyond. And this is a focus of ours in the next couple of years, in the 5 to 10 year horizon, is to really have a broader geographical footprint. One aspect that, as I mentioned, we invest in companies that create positive social and environmental outcomes. And some of the themes that we track closely include climate change, farmer profitability, food access and affordability, and human health. Our companies have added 1.6 billion to the system overall, but as you can see on this slide, food and ag remains underinvested as compared to the other sectors. So in 2019, food and ag represented about 20% of the GDP, but less than 7% of the total VC funding. For example, as compared to healthcare that has a similar GDP and pretty much double the funding. And I think this is an area that we are actively focused on in terms of catalyzing more capital to the food system, and we see a lot of opportunities for innovation and entrepreneurship across the value chain. To date, we have committed about 700 million to the sector, and as I was mentioning, we invest alongside sector-focused funds, corporate funds, but an emerging trend that we're seeing is that larger generalist investors have taken interest and have deployed capital in the food and ag space. What we're seeing is that many of the generalist investors are investing more in food delivery and retail type deals that will feel comparable to other sector and have more of an iterative approach to investing style. So at S2G, we believe that building a healthier and more sustainable food system will require a drastic shift in the way that we approach food. So you see here that we invest across production, supply chain, and consumption. But as you'll see on the next slide, we focus a lot on the production side. We spend a lot of time thinking about adoption of new solutions and what it needs to hold through to accelerate adoption. So I'll spend a few moments on the production side and what we believe are some things that need to hold true to achieve that mass scale adoption that Shauna was talking about. So for example, in terms of ag inputs, what we believe needs to hold through is that 1, efficacy needs to be proven and well documented. 2, growers need to have assurance to facilitate adoption. 3, licensing and distribution agreement need to be in place in order to enable scale. And regulatory approvals must be in place to move from pilots and testing to significant revenue generation. In terms of digital ag, similar to what we talked before, I think that what needs to hold true to, again, eliminate some of the friction points to adoption include, there needs to be clearly defined and mutually agreed upon use cases. And this is very important. And these need to be grounded in an ROI for the channel and for the end user. What we're also seeing on the digitalization side is that ultimately success depends on facilitation through a trusted advisor and relationship between solution provider and end user. So, and we also believe in a relationship building approach between the companies, the end users, and also the trusted advisors. So again, this is a very important circle of trust. In terms of the supply chain, some of the areas that we see that could accelerate adoption is that the industry needs a sense of urgency to adopt new technologies that solve a specific problem or need, and very importantly, are delivered at a price that customers are using to pay. Also on the supply chain side, we believe that innovating pricing models can be helpful in pushing broader adoption. If you move to the next slide. So our thesis is really underpinned by, next slide, by a changing consumer, and this involves access to nutrition, access, and assurance. And you see here some of the stats around more traceability, less loyalty to mega brands, and also on the access side, more decentralized and more digital online and grocery. And although our thesis is underpinned by a changing consumer, we believe that change fundamentally begins with production systems. And that's an area that we want to dedicate as many tools or technologies that we can invest in for farmers to achieve profitability, to achieve decommodification, and ultimately enable better outcomes both for farmers and consumers. So with this broader approach to portfolio constructions, one of the questions that we frequently get asked is, how has COVID changed our investment approach? And within that, I will speak about 4 themes. So the first one is digitalization, and this is something that Shauna spent time talking about, and I think, and we are in agreement with a lot of the trends and investment themes that she's highlighted. We see that while advances in technology such as genetics, soil health management, automation, and imaging help farmers manage their business, the complexity of farming still require growers to make hundreds of decisions that can impact the yield of profitability of the harvest. And we do see an opportunity of technology and data-driven decision-making to further increase profitability and help farmers manage the range of decisions they face on a daily basis. In terms of the last mile digitalization, we see right now online groceries are only 3%, but that's expected to quadruple in 2023. So that's a big trend that we're seeing. A second one is around modular systems. So that is food systems that are more agile, they're closer to the demand center, so shorter supply chains, a more direct connection between farmer to consumer than in centralized systems. And indoor ag is a big part of this modular systems approach. A third theme that we're seeing is really around decommodification. And a good example of that is what has happened in energy markets. So the transition from a top-down flow of supply demand to decentralized power market. And the public markets are showing signs of that. So Exxon, that was over a 400 billion company back in 2013, now is no longer part of the Dow. So this type of decommodification approach is something that we think will happen in the commodity markets over the next 5 to 10 years. So we focus a lot on how farmers can make more money per acre, but also do it in such a way that creates premium outcomes for consumers. So examples can be seeds that create food with better flavor and nutritional attributes, and also production modalities that can be more interesting for soil health and consumer health. And I think there will be certain producers across the food system that may not want to stay in the commodity system. So there is an opportunity for innovation and for entrepreneurship to marry both farmer profitability with consumer health and experience. And also a fourth area that I wanted to highlight is the concept of food as medicine. So the transition from sick care to food care is something that we're fascinated by. So, for example, treatment of using food as treatment for chronic lifestyle diseases, whether it's obesity or diabetes, we are focused on personalized food e-commerce and technology to enable food prescription, and also in terms of unique and functional ingredients or platform that can differentiate brands at the aisle and have a direct link to consumer health. On this slide, you have a few, I highlighted a few of some of the trends that we're seeing and some of the latest numbers around growth or expectations of market sizing. And I wanted to highlight digital ag. This is a stat that's seen frequently, and one that USDA recently quoted in one of their papers. And I think that it's an area where we're seeing an increasing focus from both entrepreneurship and innovation, but also venture capital funds. Also alternative protein, indoor agriculture, which I mentioned about, and the food as medicine trend. If you move on to the next slide. In terms of some of the trends, We've seen a lot of investment in alternative protein. What we think is that the next generation of protein will be driven by production speed, price, and taste. And highlighting a few innovation opportunities there that we're tracking closely. This is cellular protein, plant-based protein, both in terms of production methods, but also ingredients. And this is where cost in use and quality plays a factor, fungi, and algae. Next slide. This is in sync with this modular themes that I was talking about earlier. So this is indoor agriculture. What we're seeing is stability through decentralized production. What we're seeing is automated and integrated system and redefining a perishable supply chain. And I think that the innovation opportunities are also coming from use of technology in indoor for better production efficiency. And we're also looking for food and safety and traceability solutions. In terms of the digital ag trends, we're seeing both advancement of point solutions, but similar to Shauna mentioned, the systems of systems approach. So how can you integrate some of these technologies so that they provide a more holistic solution to the farmer? In terms of looking at digital ag, some of the common adoption risks were identified in the process is, aside from the farm gate value proposition and this difficulty in understanding how outputs translate into value, how can the lack of interoperability is one that's commonly identified and one that we're actively tracking. Also, labor is a big, labor and automation are big concerns, especially in specialty produce. And we spend a lot of time thinking about solutions that can help alleviate some of those pain points, particularly around labor shortages, which are so prevalent today. And the channel digitalization process where food distribution is more agile, traceable, and personalized. This is a long-term trend, and I think that we're emerging to see some of this through the increase in online for online grocery ordering from micro-fulfillment centers. So we're actively focused in investing in these areas and also focus around traceability. And the food as medicine trend I had mentioned, the innovation opportunities that we're seeing are around microbiome, as I was mentioning, for functional ingredients, precision and personalized nutrition, and medical foods. And I think to wrap, and I think in terms of, I can make the slides available if you move to the next slide, but I think in terms of what we're seeing in the post-COVID world, in terms of catalyst consideration and the four themes that I was addressing earlier. If you move to the next slide, we believe that there are second order implication, but we believe that it's an opportunity to catalyze innovation and entrepreneurship in this sort of new food system. I think that what I wanted to leave with is that we are strong believers in collaboration, and that's why I appreciate Sherry putting this panel together with such a diverse audience. And I look forward to the Q&A section, and I look forward to the ways that we can really collaborate to push forward some of the innovation and entrepreneurship we're seeing in the food system.
Great, thank you, Christina. Your presentation triggered a lot of great questions, so I'm sure we're going to have a rich and robust Q&A time together in a few minutes. But first, I'm excited to introduce our next speaker, Kiersten. And Kiersten is the managing partner for DCVC, where she invests in early stage companies that work to build deep tech platforms to develop therapeutics, improve agriculture and food, and build novel businesses in industrial biotechnology. So Kiersten, over to you.
Thank you. We can go to the next slide. So by way of a quick overview here to add to what the introduction given. So DCVC Bio, we are a Silicon Valley based venture capital firm that is actively investing out of two funds. One, which we call the Deep Tech Fund, which invests in more Silicon Valley familiar technologies like self-driving cars, quantum computing, rocket ships, etc. And DCVC Bio expressly invests at the intersection of deep technologies. We classify these as really challenging implementations of new technologies into the life sciences, agriculture, healthcare, and industrial biotech. And by way of additional background, Shauna already touched on, my partner and I also ran S2G Ventures for the time that it operated, and have been in agriculture for almost all of our careers. And so it's a keen focus for our investing. I'll go through some of those opportunities and challenges we see going forward. And just to give a sort of a definition of that, what we're really looking for are companies that have at their core one of these deep technologies. So they don't have, necessarily 5 bioinformaticians sitting in the back room somewhere. They come out of a seed of the kernel of their technology is some technology that's challenging and needs sort of special attention to grow and flourish in whatever industry they've chosen. Our ability to invest across therapeutics and robotics allows us to pull from those industries into agriculture. And I'll give you a couple of examples of those, both in therapeutics and also from self-driving vehicles, which we feel are really important to bring into agriculture to allow farmers, where we focus sort of on upstream investing, to have access to those technologies. And I think, we are about 30 people between the firm. My partner and I that run S2G Ventures, John Hamer, we're both scientists. We've both run academic projects and labs in both the human therapeutic side and also in agriculture, and have both founded companies. And so I think we focus on the very early stage of investing. So in Silicon Valley terms or investor terms, that means seed and Series A, and we do some opportunistic company formation as well. So we can go to the next slide. Thank you. So over the years, the team at DCVC Bio, we believe we built sort of the first generation of deep tech science companies, starting back in our days at S2G Ventures and then DCVC alongside that timing. We were the group that conducted the Climate Corporation acquisition and then followed on with a number of acquisitions there. Invested in companies like Blue River at the bottom of the screen, along with some current portfolio companies in closed loop robotic systems. We also invested in companies like Pivot Bio, that is a metabolic engineering company that has built microbial consortia that fix nitrogen on the surface of the roots of crops like corn, rice, and wheat. And then we also, as I mentioned, pull heavily from therapeutic modalities to generate novel chemistries for agriculture. And these include companies like Plexium that have very advanced DNA encoded libraries and are now working in protein degradation, so using the degradative pathways to regulate protein expression. Frontier Medicines that has a covalent chemistry platform, and then companies like Atomwise that is the world's leader in neural network, doing hit discovery and lead generation in small molecule chemistry. And then we're also quite active in other places like genome editing and deploying technologies like antibodies into agriculture as well. You can go to the next slide, thank you. So to add to some of the data that my other colleagues on this call have presented, I thought it was really useful to sort of show from a funding standpoint at the high level what's been happening since 2012, 2013. And this is a slide that we've kept updating, and we used to actually show it to executives at S2G when we were still there, to show why, another reason why we need to invest in this space and encourage entrepreneurs to develop really smart solutions to serve agriculture. Here I focused on upstream investing, as our friends at Ag Funder define it, which are technologies developed upstream of the consumer. This is the focus of the space in which we invest. On the left side of the figure, the yellow line across the bottom is public information on how much Monsanto spent on R&D, which up until the acquisition was the company that spent most of their revenues, proportional revenues on R&D in the industry. And you can see that after the catalysis of the acquisition of Climate Corporation, where we saw generalist investors realize this was a space they could generate returns and start investing in the space, you can see that whereas a company like Monsanto, and I'm sure you could map this onto Corteva and others, was outspending the industry on research and development. All of a sudden, the industry was massively outspending them. And so it was important then to start paying attention to these ideas and teams that were betting their lives on developing technology in agriculture. And this trend has continued. So in 2019, upstream and ag investing generated $7.6 billion of investment into this space, with over 1,000 unique investments and over 1,300 unique investors. So you can tell, like my colleagues have mentioned already, that it's attracted a broad swath of investors outside of the typical ag specialists that we saw prior to 2014. Okay, next slide, please. So what are the challenges that we see? And these are not insignificant. So the industry is in a state of consolidation and they're in process of deleveraging. These would be the potential acquirers and consolidators of the technology that we're all investing in, that entrepreneurs are betting their lives to develop, to the point where a couple of these companies have made public statements that they won't be acquiring new technologies in the foreseeable future. And this should, and we expect to create downward pressure on pricing and people that are willing to take a risk in this space, which for those of us that love agriculture and have been investing in this space for many years is a challenge for us. And then coupled on top of this, as we mentioned, there's over 9 billion of capital that have gone into this industry just last year alone. That's over 19 billion has gone in between 2017 and 2019. And we've yet to return anything out of that when compared to, say, in the therapeutics industry, where we also invest. We've had 48 IPOs this year alone. And so this is also something that investors have to look at and really contemplate how we're going to compensate for this market. Michael Swanson at Wells Fargo notoriously says, right, there's only been $2 billion of significant exits in the space that have generated, over the last sort of 7 years that have generated venture returns. I know everyone on this call will be nodding their heads. This is a huge challenge. And then depending on your viewpoint across all of the industry, across all of the sectors that this panel invests in, there are, various forces working against science-based improvement in agriculture and more towards a romanticized or idealistic notion of agriculture. And that causes some consternation for investors in the space as to really how to respond to these different types of forces. And then, just to plant a thought in everyone's head on this call is this leads us to the point of, can new companies in this economic environment be disruptive in agriculture? And there was a really nice article that gave voice to this concept that as an ag investment community, we've been talking about for a couple of years now, that was written by Shubhang Shankar, who is the managing director at Syngenta Ventures now, and it's posted on LinkedIn. And I've stolen a quote here from him, which is, ag tech has been more than just the god that failed, it is the rebel that has been tamed. And whereas we had aspirations of providing bolt-on technologies to some of the big agriculture or ADMs, Cargills, et cetera, are we now stuck in a pattern where we were prior to 2013, where we really had to go through those channels in order to be commercialized? So it's a really interesting point of view that we've been discussing. Okay, we can go to the next slide. Thank you. However, of course, we are active investors in the space. And where do we think that the opportunity lies given this backdrop? Agriculture today continues to be one of the most dangerous jobs in the world from a labor perspective. And those labor shortages, in addition to that, continue to become more acute across the world for various different reasons. There are and continue to be vast opportunities to develop climate resiliency if we are allowed to pursue the science in a way that's rational. Aggregation of land and the stewardship of land continues to be a challenge in smallholder environments where it's difficult to roll up land from a physical standpoint the way countries like Brazil and the United States have been able to do. In other jurisdictions, it's much more of a challenge. And so we spend a lot of time thinking about how that can be done virtually. We do believe, and you've seen from the way we've been investing, that fully closed loop robotic systems that measure and execute on the intelligence that it gathers using fully autonomous systems borrowed from the self-driving car and truck industry are going to be very important. And this drives the concept that, you know, the days of investing in just improving yield for farmers going forward, we believe has passed, and we really need to focus on technologies that generate increased cash flows for farmers and allow them to operate their farms in a different way. And then, as I've mentioned, we're very focused on emerging biotechnologies, compute, and new chemistry modalities to borrow from other areas to bring into agriculture to solve some of these really challenging problems that we face around the world, like chemistry resistance and things like that. So I'll pause there because I know there'll be questions. And thank you for having me, and look forward to the last speaker here.
Great. Thank you, Kiersten, for sharing your expertise and your leadership. It was wonderful to hear some of the other speakers reference some of your earlier work as well. So thank you for that. So our next speaker really represents a very different investment class, and I invited her to share that perspective intentionally because we wanted that full landscape view of investments in the food and ag space here. So Joelle is the founder and CEO of Area 1 Farms, a company she founded in 2012. Area 1 Farms uses a farmer-centric private equity model to sustainably scale independent Canadian farms, and she'll be sharing more about that model. So thank you for joining us today, Joelle. Look forward to your remarks.
Thanks very much. So first of all, thanks everybody for joining. It's a pleasure to be here. As was said, Area 1 Farms invests in farmland. And actually, just to put it in context, we actually only invest in Canada. So we invest primarily in row crop commodity land. So wheat, canola, oats would be our three biggest crops. And we invest only in partnership with farmers, and mostly in what somebody from Ontario would call Western Canada. So Manitoba, Alberta, some in Northern Ontario. So we don't tend to do much on the East Coast, and we don't do anything outside of Canada. And our approach so far, we've invested about $300 million. We own 140,000 acres in partnership with Canadian farmers. And we have a real focus, which is slightly unusual for this space, particularly in developed countries, of focusing on land that has fallen into disuse and bringing it back into agricultural production or increasing its productivity. So irrigating unirrigated land, or more so bringing kind of overgrown pasture or recreational hunting ground back into agricultural production. The unique piece that we have in that's pretty important for both an ESG perspective and an overall kind of how we look at the world perspective is not only do we own with farmers, but they also earn extra income and appreciation for running the farm. And so while sharing appreciation with a tech founder would be completely usual, that is not the case in capital intensive industries. So not only do you not see it in agriculture, but you tend not to see it in things like construction or real estate or infrastructure, mining, anything that's fairly capital intensive. You tend not to see that appreciation gain go to the operator. You tend to see it all accrue to the investor. And we wanted to test changing that aspect. Next slide. Perfect. So the reason that investing in farmland is of interest at all is because it's a real asset with long-term returns that are stable and largely uncorrelated. That's true not just for Canadian farmland, but for farmland in general. So we serve some individual investors, but increasingly institutional investors. And their interest in it is because of this kind of long-term, stable, relatively high returns for the risk adjustment. So we're not going to be close to the other speakers on this call in terms of what we're trying to return to investors. We'll be somewhere probably around 2/3 to somewhere between half and 2/3 of the target returns of the others on the call, but they're really stable, really low risk returns. And we try to make them even more low risk both by diversifying what we do, so building into that land improvement and to some extent crop processing, and also by focusing really on low risk investments. Next slide. Most people that invest in farmland try to sell the theory that commodity prices will increase. And we actually are one of the few who don't really think that's going to be entirely right. And why I say that is, if you look at history, it is true that demand keeps increasing. And theoretically, supply should be falling short. But like you've heard from everybody on the call, there is continued investment in technologies. And we think that that continued investment, be it in mechanical stuff, so better harvesting equipment, better seeding equipment, in technological, either on the seed side, the chemical side, the fertilizer side, or on practices, so the idea of regenerative farming, etc. These will all increase productivity and physical yield per acre. And seed technology keeps bringing kind of higher value crops north. So we think, let's assume that commodity prices actually stay exactly where they are. Canada will be one of the places where yields increase at the same time as demand is increasing, and as a result, farming will become more profitable. And that has been the case. So what struck me a ton about when we looked into the numbers is, on average, canola and wheat yields over 2008 to 2017 increased by about 5% per annum on the same physical acres. So if you were growing 50 bushels of canola last year, you were growing 51 to 52 bushels of canola this year. Next slide. There are a number of restrictions in the Canadian market, which is true actually for those of you joining from the States in the American market. So there are lots of ownership restrictions across all different countries. Canada is one of them. At the same time as not wanting investors to overtake investment that as a society we think should be kept largely in farmer hands, is this idea that you actually do need to grow just to keep up. So machinery keeps growing. The costs of that machinery keep increasing. You therefore need to add land to the farm. And what we see in Canada in particular is that young farmers want to return to the farm, and usually that's bifurcated. So in some families, no kids want to come back, and in other families, 3 kids want to come back. And when you have 1 kid coming back to the farm, you can usually figure out how to finance them into the business. But when you have 3 kids coming back to the farm and you need to triple in size, that's usually off the table. And so we work with those farmers to help them create a sustainable growth plan that incorporates their full family. Next slide. So our investment thesis, and the reason that we include farmers in the appreciation, is that we think it's important that farmers continue to be able to buy additional land because we think that actually gives them the stability for the operating side. And when we looked at it, I wanted to be able to attract top-tier farmers. So I wanted to say, if you're farming and you're very profitable, I want you to come to us when debt no longer suits your needs. So I actually don't want to compete with debt, but when you don't have quite enough equity to keep making debt work, then I do want you to come to us and look at us and decide that we are a better alternative than renting land and a better alternative than other methods of financing. Next slide. And so what's important to understand about this is we disproportionately give returns to farmers. And so if the farmer owns 10% of the farm and the farm makes $100 profit, they're getting 23.5 of those dollars. So to go through that again, if the farm makes $100 profit and the farmer owns 10%, they would normally get $10 profit. In this case, they're getting $23.5 profit. So they're getting 15 because they're managing the farm. Now there's 85 left, and then they're getting another 10% or 850 of that remainder. And this is not only true on the operating side, which has some volatility in it because a year may be profitable or not. It's actually also true on the investment side. And so the real key here is in a year where the crop is not profitable, but the farmland goes up, the farmer is earning 23.5% of that entire increase, even if they only own 10% of the property. And so their return in an IRR sense is higher with us than under any other method, and their risk is lower than under any other method. And our theory is that that partner, the farmer who's really making not just the operating decisions, but thinking about what land to buy, figuring out how to do it, negotiating with neighbors, etc., is really the key piece of value creation and should be rewarded as such. Next slide. So we focus on places where we can outperform because we are giving more to a farmer than under a traditional leaseback model. And we therefore need to look for opportunities to help the farm increase profitability overall. Rather than focusing on so in one of the presentations, it was talked about that the investors have driven a lot of technological change. We leave that to our farmers. So they decide what technology is getting used for operations, but we do focus on developing internal expertise for land improvement and reclamation and sharing that with partners and potential partners and even non-partners, so people who want to learn about that. And then we look at certain associated businesses when a farmer brings them to us and we help them think through how to scale that business. So we look not just at what can we do in terms of kind of being an extra piece of land for them, but as they look at their own business, we try to think through their business and say, here's actually where we will really be able to accelerate your growth. And so while they keep the associated business on their own, we are able to help them kind of grow that in tandem with the land base. Next slide. We have extremely strong ESG outcomes. So from an environmental, social, and governance standpoint, we have much higher outcomes than under other structures. And the reason for that is I understand it. So when I discussed with the PRI team, Principles of Responsible Investing, is I always said, you know, we get really good outcomes because otherwise our farm partners' kids get beat up at school. And they said, well, that's totally normal. Like I thought I was kind of making a joke. And I said, what do you mean? And they said, well, the closer that the person with the operating decisions is to the community, so physically closer in location, the better ESG outcomes you get across the board. And so the reason that you need a lot of kind of these ESG policies is when head office moves away. And they reference back to company town. So the idea of Hershey or Ford giving higher wages, extra benefits, infrastructure to living, etc. And that when head offices move away, you don't get that. Because our decisions are getting made at the farm level, we have a lot of very positive ESG outcomes that we don't have to manage for, but we do measure and report on. Next slide. So the approach that we take is unusual. The idea of sharing appreciation is probably not, it's not unusual when you get into a technology realm, but it is unusual in a really capital intensive industry. And it is hard to justify. And so we focus on partners that are really committed to growing and operating with us in ways that we can determine to create extra value. And that has worked very successfully for us. So we're on our fourth fund. We have expanded to different provinces, as I said. We are still at the moment entirely Canada-based, but it is a model that I think could expand to other geographies. And while we're only in row crops, it could probably expand to other kinds of farming, though not all of them. Perfect.
Great. Thank you, Joelle. And I can see from our questions on our participant list that we actually have people in the audience from both the US and Canada. So I will be sharing some questions from Canada as well when we get to the Q&A piece. So now before we open it up to take some questions from our audience, I'd like to just open it up to our panel participants to see if you have any reactions or responses to anyone else. And we can go to speaker mode now, I think, as well. Great, and you'd need to unmute yourself if you'd like to respond or react to something that one of the other panelists said.
I was particularly interested in, Joelle, your model around sharing appreciation or appreciation gain. And I was starting to think about other ways within, does it just apply in a farming setting? Could that also apply to, midstream processing as well? And I'm thinking about beef cattle, for example. Are there ways to create a more, or to help share some of the margin and risk for beef cattle producers to have them more involved as owners of primary processing, for example?
We don't know. So the general theory for sure can work. What I don't know about that is the economic, like where you have to be for scale of beef processing, for example, to work is just so big. You need a lot of buy-in, not just from the supplying side, so the farmers, but also from the plant and management within that plant and the sales arm and like all these other pieces. So where we've been really successful is with farmers that already have some sort of downstream processing. So they might grow seed, they might export product, and they already have a business where they understand the management team and scheme and how far down incentives would have to go. And we basically, what we've been able to do in that side, which would be true in a beef processing way, is we've been able to guarantee supply. So when you look at beef, for example, if beef price is high, the processors, the store price isn't changing very much. So the processors are making a lot of money. If, the farmers are making a lot of money. If beef price is low, the processors are making a lot of money. By owning the upstream part, we can guarantee long-term pricing. And I do think that has a very big potential role to play as you go into other downstream markets. It just means being able to make probably more complicated agreements with more people, which we've never tried.
Great, thank you. Anybody else want to raise a theme or a reaction to one of the other speakers before we open it up? All right. So as the questions came in, I know that some of you, we have multiple people that can respond to some of these questions. So I think one of the first one I'll ask is one that a variety of you could answer, and that is around data interoperability. So Steve Coulter with Coke in Kansas raises that question of, with so many small companies out there, what do you see as the solution, or what do you see as some of the emerging solutions around data interoperability?
I'm happy to jump in there. So I think thinking on this, at least from my standpoint, has evolved over the last couple of years. And I believe what we're still missing is one of the big guys to step in and provide the data platform, right? Where the data can be housed, where it can be cleansed, where, then you can start to, some of the smaller companies can start to do what they're really good at, the analytics, the insights, but really to have this kind of data backbone, data infrastructure. Companies like Microsoft are starting to move in that direction. I think we'll probably see other larger incumbents who are trying to kind of create this data platform. Certainly, Deere and some of the other big OEMs, I think, have designs on that as well. But there's that kind of data backbone, data infrastructure piece that's still missing. And I see a lot of small companies, trying to solve some of those problems that, on their own, and they're very capital intensive. They're very difficult problems to solve when it comes to, ingesting data, cleansing that data, organizing the data. And so I think that's just, big IT companies have spent decades figuring that out, and we're still waiting to see one of those guys emerge as kind of a leader in the space.
Okay. Christina?
Yeah, and just to add on that, I think that in looking at incentives across the system, what we're seeing is also a CPG pull through, whereby your CPG is working with different companies to aggregate and implement different data sources to either increase transparency or better production visibility across their farmers. So we are seeing early signs that some of the larger players are starting to integrate different data sources. I think this is also CPG, some of the large manufacturer digital platforms, as Shauna mentioned, but I would say that it's early proof points, and ROI to the channel is key driver of that.
Great, thank you. Anybody else? All right, if we stay on the data theme for a little while, we have a variety of questions here. So from Karen Stuck, she raises the role of land-grant universities. So while we're focusing on the role of capital for innovation, what are your thoughts in terms of the role of land-grant universities, either for innovation or adoption or solving some of these other issues?
But yeah, I can start if you'd like. You know, I think this is an important role. One of the features that we've observed over the years of investing, especially on the technology side, so software enabled type technologies, is that in order for there to be market pull, the market has to understand the technology and how to use it. And we're still in a time in certain jurisdictions where a lot of farmers don't have email addresses. And so the land grant universities can be extremely helpful by making sure people get deep training in emerging technologies and how they might influence what they're doing, versus just understanding agronomy and sort of the more traditional practices that we all learned about in our past lives. So it's important that the universities continue to play a leading role in adopting and making sure people understand those new technologies and the potential for them going forward, because the hope is here that agriculture can catch up to other industries, and that will increase the velocity of change that people will have to understand. And that's coupled with, you know, farmers are notoriously an older group of people, and we're anticipating a big turnover. So I think land grant universities have a role in preparing society for that turnover.
Great, thank you. Other responses to the role of land grants? All right, so we have a question from Renee Vassilos with the Nature Conservancy. And she was wondering if any of you would like to share your thoughts about how technology can help with the shift towards farming for cash flow versus for yield.
So I love this question, and thinking about that idea of farming for cash flow. So last year I did a pretty deep dive into farm management information systems and really looking at that intersection of digital agronomy and what happens in the office, right? Farm ERP or ERP Lite, and really understanding the true cost of production. How do I allocate equipment? How do I allocate labor? How do I allocate overhead to fields or farms? I think that's something that is we're still very much in the early days. I mean, you know, sort of standardized data extraction for general ledgers is very difficult for a lot of these companies to figure out how to automate. But I think we're moving in a very interesting direction there, such that farmers, you know, it's really about creating technologies that can help farmers and ranchers be better businessmen and women. You know, what are the tools that are available, again, to really understand those true costs of production and to be able to then run scenarios to say, if I, you know, implement this practice, or if I buy this piece of equipment, how is that going to impact my cash flow at the end of the year? And really sort of thinking about that kind of metric for decision making.
Yeah, and I can add to the other side of that. I think if for the entrepreneurs in the audience, or people that are thinking of starting or spinning out technologies, it's important, I think imperative, to not think about your offering in terms of how can I increase yield for a farmer alone while ignoring costs. I think those days are over. We need to think about what parts of the crop budget you're borrowing from or stealing from in order to reduce the overall cash outflows and increase the overall cash inflows to the business. I think it's table stakes now if you want adoption.
Yeah, and I think in terms, looking in just in terms of the stats, I think the net cash from income is projected to be down 15% this year, and then incrementally down next year to 95 billion. So about 103 billion this year and then 95 billion next year. So focus on technologies that generate cost savings that are essential and not nice to have is what we view as critical to generate some of the adoption.
Great, thank you. So while most of your focus is on new startups or new entrants, one of the questions is, what do you think needs to be done, or what is being done to stimulate change from industry incumbents?
Yeah, and I think, and I can jump in, we, as I was mentioning during the presentation, we have a very collaborative approach to supporting innovation and helping technology scale. And what we're seeing is, in terms of incumbents, whether it's through their venture funds or through balance sheet, there is an increased focus on outsourcing innovation. So we view incumbents part of the solution and part of generating this innovation and catalyzing some of the change that we are talking about. I think it's and I think we're seeing that throughout the spectrum, whether it's CPGs or the large manufacturers, even processors. There are various trends that converge, and similar to what we're seeing in the what we saw in the energy sector, we think that transformation is changing, and we think that the collaboration is critical to make sure that it's successful and you can execute it at scale.
Yeah, I mean, I think just adding anecdotally to that, over the course of the last year plus, the number of corporate partnerships with startups that I've seen announced is significantly increased. And I think that's a signal that, you know, corporates very much at the C-suite and then the board levels are saying, hey, what is our digitalization strategy? You know, there are a lot of startups that are, and not even startups, it's hard to call Indigo or FBN a startup these days, that are raising a tremendous amount of money. They're making a lot of splash in the market, and you know, what is our response going to be? And so I think I've been very encouraged by the volume of corporate partnership activity that we've seen. And I also think it's interesting to see, you know, people who have left the C-suite and gone to work with and for startups. And so I just think that that pace and velocity of collaboration, as Christina has said, is really been encouraging, you know, for kind of this maturing of a lot of the technologies and accessing the talent, the resources, the capital that some of these larger corporates, of course, distribution, that they can bring to bear.
Yeah, and I mean, we can add to that. I think it's important I'll make 2 points, that from a corporate standpoint, it's important to incentivize employees to be porous, to be open, to seek new technologies. It's very easy in some of these really large companies to become very inward looking based on how the ag industry is structured. And so I think it's important to incentivize not just certain groups of employees like their venture groups, but all employees, that, you know, bringing technologies home, keeping eyes and ears open is important. And then the other thing we're observing, and I think is a good thing, is that some of the smaller agricultural companies are really using this as an opportunity to get ahead. So while some of the bigger players are focused on IPOs and deleveraging and consolidating, there are some, I would say, you know, upstart, some of the smaller companies are using this as an opportunity not only to pick up executives from those companies, but also to really try and claw some of that market share out. So I think that's encouraging for all of us.
Great, thank you. So Joelle, we've had a variety of questions around the farmland, so I'm going to cluster some of those together, but maybe first start by saying, in Canada specifically with your model, who are you competing with?
So just to give you a sense of the market, Canada has about $10 billion of farmland trade a year, and we're investing, give or take, $100 million a year. So we're a very small part of the market, and most farmers don't know about us. So our size makes us not very much competition for anybody. We lose in most on-market transactions, so we are not particularly high bidders with our partners. The partners are co-investing, so they pick prices that they're comfortable with. So we're mostly off-market transactions, meaning we're mostly buying with partners from neighbors who want to sell to them. We get referrals from banks. So usually we're working with farmers who could actually finance most of this through a commercial bank, but are not comfortable with that higher level of debt. So we don't end up really competitive with banks. We're probably a bit competitive with investor groups, like in groups that would buy land and rent it out. That is another way to secure some sort of longer term access to the land, which is what a lot of our partners are looking for. It doesn't give as strong access, so a lot of the time renters flip over because the people renting want more money over time. They're not risk-sharing ventures, etc. But from a farmer perspective, they certainly decide between a straight kind of finding somebody else to buy the land and then renting it, or partnering.
Great, thank you. And then people are wondering about, intrigued by your model, but wondering if you've seen other similar models either in the US or Europe or elsewhere in the world. That
we haven't. So what we've seen from investors generally is in row crop commodity land, the simplest method is to buy land and rent it out. And that is true. Like, we have a much bigger back office. We run all the expense items for all the farms through our office. We have a fairly complicated system because we have to look for leakage, etc. Like, there's a lot of pieces that have to get managed in a way that you don't need if you're renting land. So it's a little bit difficult. And then when you get into the higher value crops, permanent crops, etc., a lot of investment firms try to buy and own the whole entity. So it's not a share. They usually take more control in terms of operations, etc. So we haven't seen this proliferate. And one of the questions we always get is it scalable? And at our level, it is. So as we grow kind of into bigger funds, it is completely scalable. I don't know if that's true when you become an entity that's going to try and deploy a couple $2 billion a year. Like, I just don't know where that endpoint is. So we haven't seen it replicated elsewhere.
Thank you. I know it's not your core area, others, but any shout outs to other, excuse me.
Well, I think what Joelle's getting to is we agree with. We've seen a variety of ways of working with farmers, both to tackle this process of succession and also aggregation. So we know that, as others have mentioned on this call, that you need to be bigger. And actually, the data in terms of environmental sustainability is actually supportive of that, which is something that runs counterintuitive to some groups. And so we do see greater efficiency, more carbon sequestration, and better land and equipment use when that happens. And so as a community, we do look for how can we support funds like Joelle in this, what we call sort of virtual aggregation, or how do we allow for physical aggregation? How do we support succession in the industry? There are technological approaches to support the passage of this land and the stewardship across generations. And I think funds like Joelle's and others are a key part of that.
Christina.
Yeah, and part of the decommoditization trend that I was talking about earlier, we have invested in an organic conversion farmland fund. Justin Brew is leading that fund, and part of the thesis there is as farm net income is going down, as organic is demanding premium, and thinking that with a demand from consumers and large CPGs, we are investing in that transition and conversion period. So mitigating some of the farmer period that until the crop can be sold. And it's an area that's a focus for us, and it's very active right now. And we're excited about the traction that we're seeing, and also the engagement with CPGs and linking that to the consumer preferences.
Great.
Christina, I
Yes.
just had one question on that. Do you guys see interest on the consumer side around regenerative? It's an area I've been really interested in from a farmer side.
Yeah, so we're seeing a lot of, so yes and no. I think that regenerative is something that's one of the themes that we're tracking closely. Whether that's communicating to the consumer and whether the consumer can have very clear standards around that, whether it's regenerative or soil health, that's a little bit early. So I think that, organic, more regulatory process, there's a lot of media noise, around potential for organic not being sourced the right way. So consumers are more familiar with the regulatory process and also with the ability to source from credible, very well certified sources. I think in terms of regenerative soil health, the metrics are still not very well defined, therefore not that clear in terms of the consumer ability to pay for those.
That's actually a question I get asked a lot. And so I ask others about it. And I agree with Christina that I think it's more from the investment community and the press at the moment, and then a small community of farmers and consumers. But there are plenty of farmers and consumers that aren't aware of the word at all yet. So I think it is definitely very early.
Yeah, I think this is another moniker, there's the pessimistic view. It's another moniker that describes what many farmers do already, to try and decommoditize what they're doing. And I'm not sure if that is progress in terms of actual measurable moving forward. I think if something's good for the soil, we've been practicing no-till farming and other things that we know are good for the soil, are good for climate resiliency, yet are not considered, a regenerative farming practice. I think we need to be objective and seek scientific truths in terms of what practices we promote, and not necessarily try and give them monikers because we can charge more or trade on that. I think it's a dangerous path. I would really like to see the agriculture industry not pursue as much as it can.
So I want to save time. We have some questions around food that I want to save time for, but before we move on to that, I'd like to share one question from our friend in Canada that I mentioned, from our sister organization, CAPI, the Canadian Agri-Food Policy Institute from Tulare. She asks, future food security while meeting climate change targets will require intensification of ag production. How do you see investments in sustainable intensification evolving in the next 20 to 30 years? And anybody want to kick off with a response there?
Sure. I mean, I think, Joelle kind of touched on this, and so have others. Sustainable intensification is the word you want to use, has both yielded incredible results for humankind. There's a couple of really great economists who've published in this place, including Jesse Ausubel at the Rockefeller Institute, that talks about how much land we've liberated back to nature because of this. But in addition to that, I think it's a path we need to go down, and we are going down. We need to be really efficient with the land we use, and liberate. I'd like to live in a world where we liberate as much land back to nature, as opposed to sort of increasing the amount of land we have to use because it's not as productive. And I think all of the indications in terms of technology usage are also going down that path. But as the questioner, the tone of the question is, can we do that sustainably? And I believe we can, yes. And there's a lot of technologies out there that we've invested in and others have invested in, including biologicals, robotics, et cetera, that are all moving forward along that path.
Well, and I think the counterpoint to this is the topic that we all talk about and think about, and it's waste, right? The waste that happens from the farm gate through to our refrigerators. So there's a balance of using technology, using innovation to reduce waste, while sustainably intensifying where we need to. So I think we've got to look at that from both sides. It's certainly that varies depending on a developed versus developing nation or country where that waste is occurring. But again, a lot of opportunities for innovation and technology to reduce that waste.
Great. Thank you. So if we segue over to food for a while, this was following up on Christina. I think you mentioned that food is medicine, and certainly I participate in a variety of communities where that's being spoken about as well. So the question was a very specific one about what percentage of consumers do you think would be willing to pay for this? This is from Steve Coulter at Coke, or a variety of follow-ons there of, what do you think it will take to reach a tipping point to change consumer habits so that they think about food as medicine?
Yeah, and I think unfortunately part of the pandemic highlighted the need for a change in diet and some of the associated unfortunately increases in mortality rates are also correlated with lifestyle diseases. So unfortunately, the current pandemic is highlighting the need for this type of food as medicine. I think this trend has started earlier, and I think it's definitely early on in terms of the consumer, consumer mindset. I think similar to other topics, I think the investment community, some of the incumbents, and some of the insurance companies are paying attention to the connection between food and health outcomes. I think that while right now food and medicine and healthier foods are still potentially associated with higher with a premium price point, I think that over the long term, this can be mitigated. And I'll give an example. We invested in a company called Everytable, and what they effectively do is they deliver fresh, healthy, delicious actually meals in underserved communities. And during the pandemic, they have also served at very attractive price points, the elderly population, some of the hotels that were homeless hotels that were converted. So we're seeing some of very encouraging traction in terms of the ability, in terms of the fresh and the logistics platform to change to allow for the delivery and of fresh food at affordable price points. But I think that's an area that we're actively focused on, and we see technology, and we're seeing some of the personalized food, and we see brands incorporating novel ingredients that have direct linkage to health outcomes. So it's definitely a crawl, walk, run approach, but very encouraging signs throughout that event that over the next 5 to 10 years, it's scalable, and the price point is converging to some of the other foods that we see that are prevalent today.
Great, thank you. Any other reactions there? No? So we had one question about, since all of you are either US or Canadian focused, one of the questions was, how do you see your investment thesis playing out more on a global basis? Do you see some of the same trends underpinning things in other countries around the globe? Shauna?
Happy to jump in there. Yeah, so I'm particularly intrigued right now with the North-South. So looking at Latin America, and a fair amount of my time is spent in specialty high-value crops, as well as dairy and livestock. And the opportunities for collaboration, for complementary technology deployment, up and down, let's say the Pacific coast, where blueberries are grown from Latin America up through Central America into California and Washington. Seasonally, there's a lot of sort of seasonality. So I think there is a great opportunity for us to continue to collaborate more and more with our Latin American colleagues and partners. I also see a lot of interesting technology companies emerging that have tended to be more capital efficient. I think there's an ability to really run very, very lean and accomplish really considerable progress. And so I think we can always learn from that as well. But I'm particularly excited about what we're seeing coming out of Latin America now.
Yeah, I think because agriculture by nature is a global industry, we perhaps take it for granted that almost all of our agriculture companies are multinational. Now, the industry's bifurcated. We invest in both, biotechnology and also in sort of robotics, software, sort of deep tech. I would say on the biotechnology front, the world is bifurcated in terms of where the regulatory paths are for biotechnology and plants. And so there you see some major barriers, especially Europe is the best example, where they determined that all genome edited technologies and basically any sort of biotechnology is in fact not being grandfathered in, but is going to have to require deregulation. So that puts a pretty significant barrier on whether our biotech companies can operate there. On the other hand, deep tech is able to operate, in various jurisdictions. And in fact, for our companies, they have to have an off-season jurisdiction. And so all of them have operations in South America, Australia, South Africa to some degree or another.
Great. Thank you. I keep thinking that I will wrap up, but we keep getting some more good questions here. So I'll probably ask one or two more questions before we close out. So there are a few questions about this as an investment class. And I know we have a variety of investment classes here really, but for food and ag as an investment class, if we think of it in its broadest sense, we mentioned the lack of exits compared to perhaps some other sectors. So there's a couple questions around that. Do you see people leaving the space because of that? And if not, why not? And if you don't think about it just in terms of measuring value by exits, what is the value being created by investing in this space? What do you see as value creation examples? Anybody want to jump in?
Christina? I can jump in. And I think that in terms of, I think what's interesting right now, it's what's happening in the public markets. So I think in terms of combining food and ag with an ESG focus, we've seen great public markets reception of the Beyond Meat IPO and then followed by Vital Farms. I think what we're also seeing broadly in the public markets is the emerging of SPAC vehicles. And I think there is a correlation between successful performance of SPAC vehicles and an ESG focus. So I think that what we're going to see is an early sign that companies in food and ag, so companies that are struggling with that Series C, Series D class, could potentially be funded through public markets, specifically through SPACs going forward. I think that what we're seeing is more interest in food and ag rather than less. I think investors are looking for industries that are resilient and everyone eats. So we're seeing a lot more capital coming into the space from large corporations, and definitely that's interest that's being signaled. And we're also continuing to see that as a public markets becoming a more viable exit to the space versus what has been done previously in the past.
Thank you. Shauna?
Yeah, I can jump in there. So about 3 years ago, I was asked to speak on ag tech M&A in Japan, and I had nothing to talk about. So I managed to fill 45 minutes worth of time sort of postulating. But one of the things I like to refer back to is actually that ag tech adoption curve. And if you can picture that in your mind, I sort of break that up into 3 different M&A, and my background's in M&A, so I spend a lot of time thinking about the sort of exit paths. 3 different sort of chunks, if you will. There's that first one with the triggering technologies. And we really saw that with climate. We saw that with granular and a very large exit for those investors. Blue River as well, very nice exit for those investors. There weren't a lot of those high value exits. And there's that kind of, during that sort of peak, now we're sort of seeing, I would argue in farm tech particularly, we're seeing a little bit of a trough. We've seen consolidation among smaller players. A lot of times that can be just by necessity. We haven't seen a lot of big valuation sort of exits over the last year or so. Coming out of that, and as you overlay it with more adoption, you start to hit those inflection points of business models are proving themselves out. You're starting to get real revenue, real customers. You then get another sort of swath of M&A, and it's lower value. They're more sort of traditional, probably software exit multiples, but it's a healthier M&A ecosystem. We're just not there yet. I think that will come. Those exits will come. They're not. The 100+ times revenue exits are going to be fewer and further between. They will exist, but there's going to be healthy consolidation once a good middle market emerges, and you start to get, maybe some public companies that have some currency that they can use to make acquisitions. Again, you have sort of a base of revenue, maybe some more sort of later stage investors, private equity investors who have the pocketbooks to help those companies make acquisitions. So we're still early in the cycle. I'm optimistic that this will continue to be a healthy investment category, but it's going to take time.
Okay. Any other responses on that? All right, just as our last question here, we've got, as we've mentioned, a multi-stakeholder audience today. And so we do have some folks who are interested in this as an investment class, either as institutional investors or as accredited individual investors. So their question is, how can they learn more about this class? If you have resources that you would recommend. And I think that is a challenge during COVID when, there are some fabulous investment conferences for food and ag, that may not be happening, which is a great way to learn. So any resources that you'd like to highlight today, and I would also offer that as we post this session on our website and post the presentations, I'm also happy to post some links to some resources that you either share now or afterwards with us. But any you want to give a shout out to now?
I'm so on the really basic level. So if you're just looking at Farmland, which I wouldn't imagine applies to lots of you, but maybe some, we're happy to educate. So whether you're interested in Canada or not, we're happy to share our views on things you should look for. I always send people Julie Koniger's article from when she was at GMO. It's called a Farmland Investment Primer. What I find really interesting, and to some extent for investors, probably a bit confusing about the agriculture space, is they tend to group agriculture investments, both on the farmland side and to some extent, as you get into the technology side, all as one big group. And they really carry, not just as you go across the value chain, but even within segments, very different risks within each grouping. So for example, one that's really easy to understand once you talk about it, but very, not very often pointed out, is in row crop commodity, your risk is really in the land and its appreciation, and to a very small extent in the annual crop, which is mostly a weather event related outcome. In permanent crop, a major weather event or more likely a bug can destroy your orchard. And so half of your investment is sitting in that orchard, like it's above the ground. And so the risks in those two things are actually really different, but because part of the investment is in the land, they're often grouped the same. And though I have less experience with it, it seems to me like technologies are often treated that way, like ones that are kind of from an earlier standpoint, and technologies that would, mechanical technologies versus biological technologies versus consumer industry kind of pieces, they're grouped all as food and ag, and carry very different risks. So I would suggest on our side, looking at papers that try to identify those risks or talking to people about understanding the risks in each segment. And I thought Julie's article did a very good job of that, which I'm happy to send out.
Great, thank you. I know Shauna just posted an article in the chat section here. So if people want to grab that while you're here, did you want to say anything to it?
I did, and that was just in, I think I mentioned it during my presentation, but I wrote a little blurb about institutional investing and the adoption of ag tech. So there are just some examples of how we're seeing institutional investors using ag technology and thinking about that from a portfolio management and portfolio risk perspective.
Great. Anything else? I'm trying to see. If
I would also just echo Joelle's comments about needing to look at the value streams sort of independently, whether it's permanent, dairy, ranching, beef, cattle, poultry, and commodity row crops. If you look at that tech adoption curve, it looks very different for each one of those value streams. So there is a temptation to kind of look at ag tech as one size fits all, and it very much is not in that way.
Great. Christina, did you want to add?
Yeah, and I think the way that we think about the parameters is, so the way that we manage some of the portfolio construction and also risk is around adoption cycle. And that's, and I can send some articles around that and ways to mitigate the potentially longer adoption cycle in food and ag. The second is syndicate. And I think in terms of the syndicate formation is very important in terms of the portfolio construction and access to scale. And this is linked to a potentially longer adoption cycle. And the third is financing, and this is very much macro dependent. And I would say that the fourth is one area that we talked about, which is exits, and we bifurcate those from IPO, and I share some of those insights and M&A. And I can follow up with you, Sherry, and within each of these buckets, I can share some resources that can help form a view of both the opportunities and the risks associated with investing in this sector.
Great, thank you. Kirsten, anything for deep tech that you recommend?
Yeah, it follows along the lines of what others have spoken about. I think the only way to really find out how your risk profile and what you're hoping to get out of, what value you're hoping to get out of your investment, you're going to need to talk to various people. We all have our specialty. We employ various methods, things that Christina just talked about, portfolio construction, syndicate construction, capital allocation, the picking of our teams, right, the management and how we're augmenting management in these companies, all specific to the particular area of agriculture they're in. There is huge diversity across ag. It is not a monolithic box. The metrics and risk associated with investing in livestock is different in dairy versus ranch, is different in farmland versus agricultural technology and robotics. So you really have to understand all of the different buckets and how that works in concert with each other.
Great. Well, Shauna, Christina, Kiersten, and Joelle, thank you so much for sharing your expertise and your leadership for our industry and for being with us today. And thank you to all of our audience participants for your engagement and your questions, and apologies that we weren't able to answer all of the questions, but to cluster them the best that we could. We will be hosting another forum in October around the food and agricultural platforms of both presidential candidates, and details of that forum will be available in the coming weeks, so keep an eye out for that. And as I mentioned previously, please take a minute to give us your feedback in the survey that you'll be receiving at the conclusion of this forum. So as we close out, thank you once again to everyone. Thank you for everyone's commitment to the food and ag sector. And with that, we will conclude our session. Thank you.
Thanks, everyone.
Thank you. Bye-bye.